Let's talk about the broader markets. A looming debt default deadline. Lawmakers are still unable to reach an agreement on spending, though House Speaker Kevin McCarthy just saying that some progress has been made. For more, let's bring in Joe Lavorgna, chief economist at SMBC Nikko Securities America. Joe, great to have you with us.
Thanks, Melissa. Great to be with you guys.
We're in single-digit days away from the X date. I mean, does that matter? Are we going to start seeing the damage done to the U.S., the damage done to the economy, the damage done to the markets prior to June 1?
Yogi Berra, I think Melissa said, it's deja vu all over again, and it feels that way with the debt ceiling. We've been through this so many times. There are about 5 points where there's a lot of overlap and ability to compromise, so a deal will get done. There won't be a technical default. But it doesn't mean, Melissa, we won't go to the last minute, and the last minute isn't necessarily June 1. I'm guessing it's somewhere between June 1 and June 9. The reality is Treasury has a lot of ability to make this deadline later, but it becomes all political, but there will be something done.
Yeah, we were just putting up a screen, Joe, of how the markets reacted on the downgrade of the U.S. credit rating in 2011. But the reality is that there was a deal reached prior to this downgrade. Yes. It was reached overnight between August 1st and August 2nd. So, I mean, we can make a deal, but the damage could still come.
Well, here's what I would tell you, Melissa. A couple of things. Number one, back in 2011, the rating agencies already put the U.S. on downgrade in the spring. That didn't happen this time around. Number two, John Boehner had 49-seat majority, whereas Speaker McCarthy only has 9. And that 49 seats that Boehner had were unruly Tea Party set of folks. And in 11, the economy was weak. We worried about Greece and European sovereign debt, a lot of other factors at play. So a repeat to 11 seems to me highly unlikely. Doesn't mean that markets won't wobble between now and the X date, which I'm saying is by June 9, or for that matter, the bill market, which certainly is reflecting these risks, but also because investors can't be in some of these securities for the slim risk of a technical default. They're out of certain sectors in the bill market. But again, I firmly believe this will be resolved. Maybe the last minute will be resolved, and we'll go on to the next thing.
Hey, Joe, it's Tim. So I think you just answered what was going to be my question on Speaker McCarthy and how he comes into this, and really the backing or lack of backing he's had for, since he became Speaker, or since the 15 times it took him to become Speaker. Let's layer in where the Fed is right now, what's going on with interest rates, and in terms of what this combination, though, means for your outlook on the economy. You've talked at different times on the show, leading indicators, things that really have you very concerned. Does the debt ceiling do anything to any of that?
No, it'll be, and again, it'll be solved by June 9, say at the latest. When I look at leading economic indicators, Tim, I see they're down 13 months in a row. I see they're down 8% year over year. This feels eerily similar to the 06 to 08 period where people were looking for a recession. It took a long time to happen. And of course, when we got it, it was pretty ugly. And I fear that's what's going to happen again, because household borrowing costs, not financial conditions, but what it costs households to borrow, those are at 20-plus year highs. Record mortgage rates, credit card rates, auto loans, personal loans. That's 70% of the economy. And I'm fearful that when the labor market turns, the economy will weaken quite sharply. And let me add one other thing as it relates to equities, because you guys talk a lot about that. Over the past few weeks, we've seen a significant increase in real interest rates, well above 1%. I don't believe this economy has the dynamism and the potential growth to continue to growing in the face of 1% real rates. In the past, when that happened, the economy abruptly slowed, or the Fed cut rates very rapidly. That doesn't seem to be likely at the moment.
Joe, here's one for you. I saw Melissa was on the Squawk Box this morning. You had that gentleman on from Duke who actually wrote. He
did the model about the inversion, the yield inversion, saying that inversion signals recession.
So here's one for you. Does the inversion signal recession, or does it cause one?
Both, because the inversions tell. Look, the 10-year note, even at 370, wouldn't be where it is with inflation at 5% if the market didn't believe the economy was going to slow rapidly. So that's one story. But the other, Tim, the other guy is that the curve, when it's inverted, banks can't make money. And that's why they started tightening lending standards last year before we had this regional bank crisis. So it is both a predictor and cause of recession, because the credit and money and lending multiplier basically falls apart when that curve is inverted.
Joe, do you think, we were just talking about NVIDIA, jaw-dropping pop of 23% on the back of, a crazy guide on Q2 revenues. And I'm just wondering, it may be an outlier, but that kind of move, the kind of guidance, it's not what you hear when we're about to head into a recession. It doesn't feel like it, at least. And I'm just wondering how much you think the Fed looks at that, looks at the markets. They're saying, you know what, the S&P around 4,200, too high.
Melissa, I don't like the narrowness of growth in the economy. Right now, it's being propped up by the consumer. Perhaps there's some excess savings. I don't see a lot of growth on the CapEx investment side. Housing's in a recession, manufacturing's in a recession. NVIDIA is a great company, obviously, but when you look at the breadth of the equity market, it kind of parallels the breadth of the economy. It's very narrowly focused. That, to me, is not sustainable. I want to see breadth. I want to see a lot of different industries, a lot of different sectors of the economy participate in the growth. And again, let's not forget that monetary policy works with long and variable lags. We've raised rates a lot. QT is going to restart. It's possible we're going to get massive bill issuance. The liquidity will be sucked out of the market as the Treasury rebuilds its operating balance. I mean, this could be a very fraught environment for equities over the summer. So, no, I don't take solace that one particularly impressive company's done well.